Hello. Okay. So, very good afternoon, all of you all. Let us now continue from where we left yesterday. Okay. We started with income from other sources. Do you remember income from other sources? How many heads of income? 5. This is the last head of income which we are doing. Okay, no? After this, all the things are very easy. In fact, this chapter is also easy. Yesterday we started with charging section, general charge, specific charge. Okay, so under the specific charge there are many incomes. The list of those incomes we have written yesterday. Okay, out of all those incomes, one income, the first income which we started discussing was dividend income. Okay, so if we talk about dividend income is taxable under the head IFOS. Specific charge is there. The dividend cannot be taxed under any of the other heads of income except for other sources. Okay. How many types of dividends are there, sir? There are 3 types of dividends under the Income Tax Act. 2 types are there in accounts also, sir. But one extra type of dividend is here. That dividend is known as deemed dividend. What will you call it? Deemed dividend. So, deemed dividend is given from section 222 clause A to clause F. There are 6 points, 6 type of payments or distributions by a company to its shareholder. These 6 payments or distributions will be treated as deemed dividend in the hands of the shareholder, and accordingly the shareholder will have to pay tax on these type of dividends. Okay. Now, sir, yesterday I told you that distribution of profits by a company to its shareholder in cash will be treated as what? Dividend, either interim or final. So at that time, usually what entries are passed in the books of accounts of a company? If you think from the perspective of a company, what entries are passed to give the dividend? Come on, first entry. You all know accounts, no? Little bit, little. Okay. So tell me, what entry will be passed? What will be the first entry which the company will pass at the time of giving the dividend? Tell me, come on, fast. This will be the first entry. The dividend will be debited to P&L account. Yes or no? P&L to dividend. What will be the second entry? Dividend to shareholder account. Right? No? Shareholder will be given the credit for this dividend. What will be the third entry? Now the shareholder will be paid that dividend. Done? These 3 entries are passed. Now what happens? Dividend cancel. shareholder cancel. What is the net entry? Come on, net entry. P&L account debit to cash or bank account. That is why it is said distribution of profits in the form of cash. So this can be for interim dividend also, the same entries are passed, and for final dividend also the same entries are passed, no? Meaning the dividend is given in cash, in money. What if instead of cash some asset is given? Don't you think it should also be treated as a dividend? What if instead of cash, instead of some asset, some debentures etc. are issued, bonus shares are issued? Don't you think that this should be treated as dividend? Because if these things are not treated as dividend under the Income Tax Act, every company will start paying the dividend in these manner, So the government said, that's it, distribution of profits into cash is a dividend, either interim or final, will be taxable as your income from other sources. But if the profits are distributed in the form of asset, any other asset given, or the distribution of profit is happening, but assets are not given, cash is not given, assets are also not given. By reducing the cash, by reducing the asset, the dividend is not given. By increasing the liability, the asset can be given, the dividend can be given. How? By issuing the debentures, by issuing debenture stock, deposit certificates to the shareholder. Or it can be given by way of what? Given by way of bonus shares to the preference shareholders, who usually get what? Dividend only. It can be given by the company at the time of liquidation also. What if these profits are distributed when the company is a going concern? That time it is a dividend. But what if the same profits are distributed to the shareholders at the time of liquidation of the company? Then also it should be treated as what? Dividend only. What if the capital is reduced and some distributions are made? That is also a deemed dividend. And what if loans or advances are given to the shareholder? That is also a deemed dividend. So there are 5 cases. In fact, 6. Sixth one is inserted from this year onwards. Okay, no? So the very first case is 222A, which talks about distribution of asset. 222B, which talks about distribution of bonds, debentures. Debenture stock, or deposit certificates, or distribution of bonus shares to preference shareholders. 222C, distribution at the time of what? Liquidation. Distribution can be of cash or it can be of assets also. 222 D, distribution out of, distribution by reducing what? Capital. That distribution can also be of cash or any asset. 222 E, this means granting of loans, advances, and last but not the least, 222 F, with effect from 1st October 2024. These 6 points are there. Will you remember? Sure, sir. If the company is giving you any asset, you are a shareholder. That distribution by the company is treated as your deemed dividend. Why the company will give asset? Because if cash is given, no, it will be treated as dividend. So to avoid that, the company will give you asset. Caught. Even if you distribute asset, it will be treated as dividend only. So what will be the amount of deemed dividend in this case? See, if I make the balance sheet of the company, no, for example, this is the balance sheet of the company. One is asset side, one is liability side, right? No. So this is liability side, this is asset side. So on your asset side, cash and bank balance, cash or bank balance, the amount is there, but the company does not want to give this amount. Why? Because if this is given, then definitely it is what? Dividend. So distribution of cash or bank, distribution of cash will be treated as dividend. So to avoid that, the company can give what? Any asset. The book value of this asset is something. For example, the book value is 3 lakh only 3 lakh. But if you see, the fair market value of the asset was 5 lakhs. How much was the fair market value? 5 lakhs. So how much amount of dividend the company has paid by way of distributing the asset? 222A says that distribution of asset is treated as deemed dividend. Yes or no? So the amount of the asset, that amount of that asset will be treated as what? Deemed dividend? No. So what amount you will take? Will you take the book value of the asset or the fair market value of the asset? Always the fair market value of the asset. To this extent, it is dividend, not the book value. Book value can be any amount, no? And book values can be manipulated also. You can lie, but the market cannot lie, no? So the fair market value of the asset as on the date of distribution. The fair market value of the asset as on the date of distribution, that fair market value will be treated as your deemed dividend. So how much is the balance sheet value of the asset? It is only 2.5 lakhs. How much is the fair market value of that same asset as on the date of distribution? It is 5 lakhs. So how much will be the deemed dividend? Will it be 2.5 lakhs or it will be 5 lakhs? It will be 5 lakhs. Because as on the date of distribution, the asset which is given, the market value of that asset is 5. So how much benefit you are getting from the company? 5 only, no? Let that 5 be treated as what? Deemed dividend. But wait, don't you think that the dividend can be given to the extent of accumulated profits, to the extent of reserves only? Beyond that, dividend cannot be there, no? At the most, how much dividend the company can give to its shareholder? To the extent of the available profits. So if you are treating this 5 lakh as a deemed dividend, this entire 5 lakh will be your deemed dividend. If it is less than or equal to the amount of reserves, accumulated profits. What if the accumulated profits? Here, accumulated profits will appear on the liability side, no? Reserves and surplus. Meaning accumulated profits. Yes or no? This amount can be given to the shareholder in the form of what? Dividend. And what if this amount is 10 lakh rupees. So out of 10 lakh, 5 lakh can be given as a deemed dividend, no? So 5 lakh, entire 5 lakh will be treated as deemed dividend. But what if this reserves and surplus was only 4 lakhs? Can you get a dividend of 5 lakh if your reserves is only 4 lakhs? So to the extent of 4 lakhs only, the fair market value will be taken as your deemed dividend. Excess will not be treated as deemed dividend, only to the extent of accumulated profits. Now this reserves you are supposed to see as on what date? As on the date of distribution. The date on which the asset is distributed, as on that date, what is the reserves? To that extent, the fair market value of that asset will be treated as your deemed dividend. Hello sir. Sure sir. Do this part. Read it. Company distributing or releasing asset to the shareholder. That distribution is known as deemed dividend. But the market value of the distributed assets as on the date of distribution, this market value of this asset will be treated as deemed dividend. But wait, to the extent of accumulated profits as on the day of distribution. Market value will be your deemed dividend. But for that, your reserves should also be equal to or more than that market value, no? What if your reserves are only 4 lakhs and the market value is 5 lakhs? Then entire 5 lakhs will not be treated as deemed dividend, only to the extent of 4 lakhs, to the extent of accumulated profits. It will be treated as deemed dividend. Will you remember? This is A, 222A. Now come to the balance sheet. Will the company give cash or bank? No. Because if cash or bank is given, then it is, by default, it is a dividend. So to avoid that, the company started giving what? Asset. So now even the asset will be given. What will happen? It will be treated as deemed dividend. So what the company will do? By decreasing the assets, the dividend can be given. So by increasing the liability also, the dividend can be given, no? So instead of giving the cash, instead of giving the asset, debentures are issued. Liability increased. Hello. Debentures are increased. Debentures are given. Debenture stocks are given. Deposit certificate is given. Yes or no? To the shareholder. So the last entry which I have passed here, what will be the last entry? P&L debit to cash bank. Shareholder account debit to cash bank? No, it will be now shareholder account to asset. If shareholder account to asset was there, then it is a dim dividend. 222A. So to avoid that, what you did? Shareholder account debit to debenture, debenture stock, deposit certificate. Yes or no? So if any debenture or debenture stock or deposit certificate is given to you, meaning by increasing the liability, yes or no, then that will also be treated as deemed dividend in the hands of the shareholder. Will you remember? So now what you will see? You will see that debentures are issued. Debenture, deposit certificate, issued. So you are supposed to check the debenture or debenture certificate. What is the fair market value? What will you take? You will take the fair market value, not the book value, huh? What will you check, guys? Book value? No, you will check the fair market value of these debentures or deposit certificate. So there, fair market value as on the date, not the book value. Book value you can keep any amount. Getting my point or not? So don't check book value. Always check what? The fair market value as on the date of distribution. So the fair market value of the debenture or deposit certificates issued to the shareholder, that fair market value will be deemed as dividend under section 222B. Under which section? 222B. Getting my point? Now tell me one thing. The fair market value is 8 lakh rupees and the reserves and surplus is 10 lakhs. So if these bonds or debentures were not given, normally the dividend would have been given, then how much dividend the company would have been able to give? 10 lakh? No, because the reserves and surplus was 10 lakhs. Hello, sir? So if reserves and surplus, if accumulated profits are 10 lakhs, so to the extent of 10 lakh, the dividend can be given, no? So the distribution of bonds, debentures, debenture stock, deposit certificate will be treated as deemed dividend to the extent of reserves only, no? As on the date of that distribution. So as on the date on which the debenture etc. are distributed, as on that day, whatever was the fair market value will be treated as your deemed dividend, but it will be treated as deemed dividend to the extent of reserves and surplus, to the extent of accumulated profits as on that day. Will you remember? Can you decrease the asset? Now can you increase the liability? If you decrease the asset, it will be deemed dividend. By increasing the liability, whenever you will give something, that will also be deemed dividend. So now what you will do, out of your reserves, you will issue bonus shares. Now what entry, last entry you will pass? Last entry, shareholder account debit to share capital. So your profits are utilized to issue the capital, share capital, and in the form of bonus shares. But wait, if this bonus shares are allotted or issued to equity shareholder, then it will not be treated as deemed dividend. But if the bonus shares are allotted to preference shareholders, then confirm it is a deemed dividend. Getting my point? So what now the company will do? Company will issue preference shareholders. So the preference share capital will be there. So to these preference shareholders holding the preference share capital, yes or no? To them What will be issued? Come on, tell me. Out of reserves, what will be issued? Bonus shares. So, whatever bonus shares issued, what did I say? Whatever bonus shares issued, the value of that bonus shares will be treated as what? Deemed dividend in the hands of preference shareholder. If the bonus shares are issued to equity shareholders, then it will not be treated as deemed dividend. But if it is issued to preference shareholders, then confirm it is a deemed dividend. So you now have to see the fair market value of the shares issued, bonus shares issued, as on the date of distribution of these bonus shares, whatever was the fair market value of these bonus shares, yes or no, that will be treated as deemed dividend under 222B only, but only to the extent of accumulated profits, because beyond that the dividend cannot be given only. So to the extent of reserves and surplus, to the extent of accumulated profits, whatever distribution is made, whatever fair market value is there, yes or no, that will be treated as deemed dividend. Now sir, why preference shares only? Why not equity? There can be a doubt, no? So you tell me. I would like to ask this doubt from you. Bonus shares issued to preference shareholders, that is treated as deemed dividend. But if the bonus shares are issued to equity shareholders, then why it is not treated as deemed dividend? Why only preference shareholders? See, your name only suggests that you want dividend in preference. Your preference is to get dividend. That is why you are known as preference, no? So the moment you became the preference shareholder of the company, no, since that time, the income tax department was very sure that whether anyone getting dividend or not, these people, these shareholders are going to definitely get the dividend. See, ordinary shareholders, meaning the equity shareholders, may or may not get the dividend. They are not given any preference or they are not given any choice. Getting my point? There are chances that they might not get dividend also. There are bright chances that they might not get dividend also. But for preference shareholders, that is never a case. They are confirm going to get what? Dividend. That is the reason why we call them what? Preference shareholders, no? And the government was very happy that okay, these preference shareholders are there. They are going to get what? Dividend in this year, and we are going to what? Get the tax on that dividend. We are very happy. The government is enjoying. Government is, dancing. That wow, this preference shareholders will get the dividend this year. This preference shareholders will get the dividend this year, and they will pay the income tax on that dividend income. Wow, wow, the year got over. Preference shareholders did not get the dividend only. Now all of a sudden the government went and asked, what happened? Why preference shareholders? Why you have not come to pay tax on your dividend income this year? It was sure, no, you are going to get the dividend, no. Preference shareholders says, sorry government, this time we got bonus. Because of you getting the bonus, now the income on which you were supposed to confirm pay tax to us, you are not paying tax on that. That is not acceptable only for us. Whatever bonus shares were issued to you will be deemed to be your dividend only. Because you are not going to get this. You are going to get dividend in preference. So why have you taken this? And by taking this, there is a loss to the government. And government is not going to bear that loss. You taking the bonus, not getting the dividend, meaning we are not getting the tax. See, this could happen with the preference, this could happen with the equity shareholders also. But equity shareholders will not be targeted. Why? Because those poor people, they even don't know that whether they are going to get the dividend. Even the company doesn't know that whether the company will pay dividend to the equity shareholders. Yes or no? So the dividend which is not confirmed, only if you don't get it, okay, or you get bonus against it, will not put us in pain, Hence, we leave you. Whatever bonus shares are received by you will not be treated as deemed dividend in your hands at least. But for preference, we are not going to leave. Okay, no? So tell me, first 2 points, 222A and 222B. Done, sir? So what will you see now? You will see the fair market value of the bonus shares issued to the preference shareholders as on the date of distribution. To that extent, the amount will be treated as deemed dividend. But wait, this amount should not be more than accumulated profits as on that day. Because to that extent only the dividend can be given. Even if it could have been given in the form of cash or bank, the dividend could have been to the extent of reserves only, no, not more than that. So now that is not given in the form of cash, now that reserves is given in the form of bonus shares. So bonus shares to the extent of this reserves and surplus value, to that extent only it will be treated as deemed dividend. Will you remember? Sure, sir. Pay attention. I cannot reduce the asset and give the dividend. I cannot increase the liability and give the dividend. What will I do with this company? Close the company. Close the company. Now, at the time when the company will be closed, at the time when the company will be liquidated, will there be reserves and surplus available with the company? Now, don't you think on liquidation of the company, after paying the outside liabilities and all, whatever reserves remains are of the shareholder only, given to the shareholders? Now, what the shareholder will say? We are getting amount on liquidation. On liquidation, whatever amount is received by us, that is towards the capital which we have contributed. So, our capital which we have contributed is coming back to us. We don't want to charge tax on that here. For that, capital gain will take care. 46, subsection 2, the amount which you have contributed, against that you are getting something. Yes or no? 46, 2. But wait, that amount which you are getting against the capital invested, against the investment in the shares, whatever amount you are getting at the time of liquidation, that entire amount is not return of your capital. Out of that entire amount, some amount is this reserves and surplus also, as on the date of what? Liquidation. This is also given in the form of cash, given in the form of asset. What if this same amount of reserves and surplus would have been given in the form of cash, in the form of asset, while the company was a going concern? That time it would have been charged as what? Dividend only, no? So why not now? Now also it will be treated as deemed dividend. Because if we don't charge this amount as a deemed dividend right now, what will happen? Everyone will start opening companies. We all will start a company, okay? We all will become the shareholders. And we will not take any single rupee of dividend for next 5-6 years. We will earn profits. We will accumulate the profits. Reserves will be created. And one fine day, we will liquidate that company. The entire reserves and surplus we will take and tell the government, we are getting the capital back. Ayyo, this is not the capital back. The entire capital coming back with some profit. But over and above that, these reserves and surplus are also there, no, as on the date of liquidation. Even this reserves and surplus are given to you at the time of liquidation. Getting my point? What if this was given when the company was running, company was a going concern? This would have been treated as what? Deemed dividend, no? Dividend only, no? Then why not now? And if we are not charging tax on this right now, what will happen? Everyone will start companies like this, earn profits for few years, will not take that profit as dividend, because if they take it as what? Take the profits in the form of dividend, they will have to pay tax. So what they will do? Don't take that profit only in the form of dividend. Let the company close. We'll close the company. See, it is not a big deal to open a new company. Let us earn income in this company. Take the entire profits in the form of dividend. Sorry, um, in the form of amount received on liquidation. Hello. Then we'll open another company. In another company also we'll earn profits. We'll not take those profits as what? Dividend. Profits will accumulate. We'll take that profits on liquidation. And every time we'll say, no dividend, okay? Capital invested is coming back. Wow. With some extra amount. This should also be treated as deemed dividend. If it is not treated, then everyone will start taking the dividend like this. By closing the company, opening a new company. For some years, the company will be running, profits will be earned. Then again, these profits are to be taken in the form of what? Dividend. They will close down the company and take this as a liquidation proceeds. Wow. So remember, any distribution, what did I say? Any distribution of even cash, distribution of even assets, yes or no? Any distribution made by the company to the shareholder, to the extent of accumulated profits as on the date of liquidation will also be treated as deemed dividend under section 222C. See, anything over and above this amount, no, will be treated as return of your capital. The capital which you have invested, the amount you have invested in shares, that amount is coming back to you along with profit. That will be taxable under section 46(2) under the head capital gains. Yes or no? So under capital gains, what we do? Whatever cash is coming to you on liquidation, whatever asset coming to you on liquidation, the fair market value of that asset as on the date of distribution, okay? Not as on the date of liquidation, as on the date of distribution, because the distribution date will come later and the liquidation date will come before that. So as on the date of liquidation you are getting the asset, or as on the date of distribution you are getting the asset? As on the date of distribution. So fair market value of the asset has to be taken as on the date of distribution only. Yes or no? So cash amount received in cash from the company plus the fair market value of the asset received on what? Liquidation. Both the amounts taken together. Out of this amount, some amount will be treated as your deemed dividend. To what extent? To the extent of accumulated profits as on the date of liquidation. Not as on the date of distribution, but as on the date of liquidation. Whatever reserves and surplus which were available with the company, to that extent the distribution of cash and assets at the time of liquidation will be treated as your deemed dividend, only to the extent of accumulated profits as on the date of accumulated profits as on the date of liquidation. Done, sir? Any distribution over and above this amount, over and above that accumulated profits, that will be treated as full value of consideration, and based on that the capital gain of your shares will be calculated under 46(2). Yes or no? Do you remember all these things we have already discussed? Should I move ahead? Okay. Now coming to the next part, 222D. Now see what the company will do. Company knows that if this entry is passed, P&L debited. Now whatever we credit, no, they consider that as a deemed dividend because it is coming out of profit and loss account. It is coming out of profit and loss account only, no? P&L, profits only. What if something is coming out of capital? What if something is coming out of capital? That something can be cash also, that something can be asset also. If that comes from the capital, meaning the profit is not distributed. Now the capital is given away. Yes or no? So what you will do, first of all, you will pass this entry. P&L 2. Share capital. Can you capitalize some profits? Capitalization of profits. Hello. Do you know what is capitalization of profits? Your reserves are capitalized. Your reserves are capitalized means issued as bonus shares to shareholders. Now your reserve was 10 lakhs. So 1000 shares, 10,000 shares of rupees 10 each. 10,000 shares of rupees 10 each. 10 lakhs, no? Hello, 100 each. Sorry, my mistake. 100 each. So 100 rupees per share into 10,000 will give you 10 lakh rupees. So you have 10 lakh rupees in reserves. You want to give 10 lakh rupees as dividend to the shareholder. Can you give it by distributing the profits? Yes, you can. But you can distribute that same 10 lakh of profit through share capital also. How come? First you will convert the reserves of 10 lakhs into your capital by issuing bonus shares. Understood? Face value per bonus shares is 100. How many shares? 10,000. So 100 into 10,000 will be 10 lakhs. Got it now? Now this 10 lakh company wants to give you, out of this 10 lakh, the company wants to give you 8 lakhs. So what the company will do, you know? Company will reduce the face value per share by 8 rupees. So 8 rupees per share the value is reduced. Now the face value of the share, instead of 100, it becomes if the face value was 100 and it was reduced by half, for example, let us say half. So now the face value will become 50. 50. Where is the balance face value? Reduced. So the share capital will be debited by that amount, and against that the cash and asset will be given. What happened? First the profit converted into capital. It appears as a capital. Now that much capital is reduced, which the company wanted to give in the form of what? Dividend. By debiting the share capital. Yes or no? And then debit share capital, against that distributions are made. Cash given, asset given. Yes or no? Don't you think this must be done by converting the profits only into capital? If the profits are converted into capital and then reduce that capital, give that capital in the form of what? Cash or asset. That can be done or not? Can be done. And if you are doing it now, 222D, which says that any distribution of cash or asset by reducing the capital of the company, any distribution, whether in cash or in assets, by reducing the capital of the company, that distribution to the shareholder shall also be treated as what? Deemed dividend under section 222D. Will you remember? But it will be to the extent of accumulated profits only. But accumulated profits are not there only. Entire accumulated profits converted into. So to the extent of accumulated profits are 0. So no deemed dividend. No. Here they are saying accumulated profits whether capitalized or not. Please listen to me. Please watch me. Whether capitalized or not. So whatever accumulated profits which were capitalized shown as bonus shares. Take that accumulated profits also and take the accumulated profits which are not capitalized. Yes or no? Add both of them. That is the accumulated profits. To that extent, the distribution will be treated as deemed dividend under section 222D. So what if the company is giving asset? Deemed dividend. Fair market value of the asset, deemed dividend. To the extent of accumulated profits as on the date of distribution. 222A done. Now what if the company is giving debenture stock, deposit certificate to any of its shareholders then? Then also it is a deemed dividend, sir. Whatever debenture stock, etc. given, no, the fair market value of those debenture, etc. will be treated as deemed dividend, but only to the extent of accumulated profits available as on that date, as on the date of distribution. Sir, what if the company is closed? So on the closure of the company, the cash is given. On the closure of the company, the liquidation of the company, assets are given. So cash is given, asset is given. Cash is given, asset is given on what? Liquidation. That entire amount is treated as deemed dividend in your hands. But it will not be treated as deemed dividend fully. It will be treated as deemed dividend to the extent of reserves as on the date of liquidation. Done, sir? As on the date of liquidation. Anything over and above that will be for your shares, which you will now transfer on what? Liquidation to the company. Getting my point, sir? Now the last point was, if you are distributing, if the company is distributing cash, distributing asset, but that distribution is happening out of capital by reducing the capital. So what you would have done? Instead of giving the reserves and surplus directly to the shareholder, first the reserves and surplus got converted into what? Share capital. Getting my point? Now that share capital which is appearing there is nothing but coming out of the reserves only. For that the shareholder are not going to give any money. So first the reserves got converted into share capital. Reserves account debit, P&L account debit to share capital. Now your share capital will increase. Your number of shares will also increase. Now you will reduce the face value. You will not reduce the number, but you will reduce the face value. You may also reduce what? The number. By doing this, no, what will happen, Some amount. What did I say? Some amount will come to you. That amount which is coming to you is nothing but your deemed dividend. That some asset can also come. That asset coming to you is nothing but your deemed dividend. Because that is given to you by converting your profits into capital, reducing the capital and giving this capital in the form of cash, in the form of asset. Even that will be treated as deemed dividend. To what extent? To the extent of accumulated profits as on the date of distribution. So whatever cash given, whatever assets given, the fair market value of that distributed out of what? Capital. So to that extent, it will be treated as deemed dividend to the extent of accumulated profits, whether capitalized or not. So take the entire reserves, take the entire profits, those profits which are appearing separately here, that also, and take that profit also which got converted into what? Bonus shares. Hello, sir. Understood? Now the last point. Second last, in fact, 222E. 222E says that if there is a closely held company. Do you know what is closely held company? The company which is not a widely held company is a closely held company. Wow, sir. It is that company which is not widely held. Now what is widely held? A company where the public is substantially interested. Company where the public is substantially interested, meaning more than 50% of the shares of the company are held by general public, that is a widely held company, because the public is substantially interested. Control is there with the company. Majority shareholding is with the public, general public. Yes or no? So that general public is having a substantial interest in the company. That means this company is not a closely held company. This is a widely held company. And the company which is not a widely held company is a closely held company. Meaning, it is that company in which majority shareholding is not with the public, general public. The majority shareholding is with some few private individuals, just like me, my relatives can be there. Me and my relatives are having the majority shares in the company. That means in that case, that company is treated as what? A company where I and my relatives have substantial interest and not the outside general public. That is not a widely held company, that is a closely held company. We 5 people or 6 people, we are forming a company, and the entire shares were held by us only. There is no other one from the outside. General public is not there as an investor. What will happen? What will you call such type of company? Company where the general public is not substantially interested, meaning these type of companies are known as closely held companies. Getting my point, everyone? Now pay attention. If this closely held company gives any loans or advance to its shareholders, now remember, any shareholder? No, only that shareholder who holds 10% or more 10% or more shares in the company. So the shareholder has to be a person who holds 10% or more in this company, which is a closely held company. Now see, for closely held company, no, there are no restrictions for granting of loans or advances. In the Companies Act, no, the restriction of granting loans, advances, etc. are very stringent. They have to compulsorily follow. Which type of companies? Public limited company. Because the money which you are having in your business, your public limited company, the company where the public is substantially interested, meaning majority of the shareholding is with the general public. You cannot do anything whatever you want with the money of the general public lying in that company. You cannot do anything with that money. That money has to be smartly, sensibly given to someone as loans, advance, so that the money does not become a bad debt. So there are lot many stringent requirements of the company's law, which that widely held company has to follow before giving the loans and advances. Yes or no? But there are no such restrictions on closely held company. Closely held company, few private people, they are having the substantial shareholding in the company. No, outside public is not involved only. So majority of the money which will be involved in this company will belong to whom? Will belong to certain private individuals. Yes or no? So do whatever you want with your money. No, if you want to, put it on fire, set it on fire, set it on fire. We don't care. If you are giving that money to someone as loans or advance, we don't care. But wait, if you are going to give such loans or advances, you can give it as per your wish. You can do whatever you want, because the company's law does not, gets applied here. There is no restrictions. So you can give such loans and advances to any shareholder in any amount, in any proportion. Now just imagine, if you want to give what? Dividend to the shareholder, but instead of giving the dividend to the shareholder, what you are doing? You are giving loans or advance to the shareholder. Why? Because if you give it in the form of dividend right now, what will happen? You will have to pay tax. If you give it in the form of dividend right now, you will have to pay tax. No, the shareholder will have to pay tax. But don't give it in the form of dividend. Give it in the form of what? Loans advance. The amount which I am giving you is dividend only, but don't call it dividend. Call it loans advance. What entry you will pass now? What entry the company will pass? Shareholder account debit to cash bank. Hello? Meaning loan. And loan to cash bank. So the loan amount will stand as your asset in your balance sheet. Now your cash in the balance sheet asset side get converted on in the asset side only in the form of loan advance given to the shareholder. Now there is no simultaneous effect on the asset side as well as liability side. Asset side as well as no, there is no simultaneous effect like that. Profits are not converted into share capital and given in the form of assets or liabilities. Getting my point? What is happening here? Simple. Cash is getting converted into loans advance. One asset is getting converted into another asset. Now for few years, no, the company will keep on showing these loans and advances, outstanding loans or advances. These loans or advances supposed to be received by this loans or advance supposed to be received by the company, no, given to the shareholder, supposed to be received by the company. So it will be shown as asset in the balance sheet. For few years it will be shown like that. After few years, written off. Dividend was supposed to be given, it is given also in the form of loans or advance, and after some years the loans or advance will be written off from the book. See, no income, nothing taxable. This can happen or not? Tell me. Are you in the business of giving loans and advances to others, a company? If you are not in the business of giving loans or advances, meaning your substantial part of business is not giving loans or advances, and these are not the advances given in the regular course of business also, then why this advance? Why this collaborative to the shareholder? We are telling you why. Because you did not want to give this amount in the form of what? Asset. Sorry, in the form of dividend. So you paid this amount, you gave this amount in the form of loans advance. Now the moment you will start calling it loans advance, meaning that this is not a dividend only, yes or no? But wait, for few years, it will be shown in the balance sheet as it is. After few years, it will be written off, meaning that this was a dividend only given in the form of loan advance. So, what type of company should be there? Closely held company. Giving what? Loans or advance to the shareholder. What type of shareholder? The shareholder who is holding more than 10% shareholding in the company. To that shareholder, if the loan or advance is given, that is treated as deemed dividend. But apart from that shareholder, the loan or advance can be given to any concern. Concern means company, firm, AOPBY, etc. Yes or no? They are known as concern. So in that particular concern, either the shareholder will have substantial interest or any of the members of the shareholder will have substantial interest. Yes or no? So from that, what did I say? From that, it is clear that the shareholder is having what? Substantial interest in the concern. So instead of paying the amount directly to the shareholder in the form of loan advance, now the company can give this loan advance to the concern, no, where the shareholder is having substantial interest. This can be by the shareholder. It is as good as given to the shareholder only, because if this was given to the shareholder in the form of loan advance, this was treated as what? Deemed dividend. Now to avoid this also, you might give the loan advance to this concern. Now shareholder will apply its what? Substantial interest, influence, and now by any way the shareholder will obtain that amount or take the benefit of that amount coming to the concern. Hello sir. So this amount given as loans or advance to the shareholder? No, to the concern where such shareholder is having 20% or more. What? Profit sharing or 20% or more, what? Equity capital, share capital. Concern can be any concern, guys, but the shareholder should be the same shareholder. Yes or no? But this shareholder is having 20% or more in the profit sharing of this concern. So any loan advance given to this concern also by the closely held company will be treated as deemed dividend in the hands of the shareholder only. Now see, what if the closely held company pays? The closely held company has paid some amount towards the liability of the shareholder. Some amount, your liability was there, no? I will pay, don't worry. Instead of giving you loans or advance, this can also be given. Instead of giving you dividend in the form of loans advance, even this can be done. I am paying your dividend like this. I'll pay some of your personal expenses, I'll pay some of your liabilities, yes or no? So don't worry. Even this will be treated as what? Deemed dividend. Foolproof pack. And now see, this part, no, 222F, I have already discussed in section. Unlisted is closely held only, yes, but not necessarily always, because see, unlisted is there, ultimately it is a public limited company. Getting my point? Or a private limited company. So a private limited company is also unlisted company, and a public limited company not listed on the recognized stock exchange is unlisted company. So what type of unlisted company you want to say? If a private limited company which was unlisted, that can also be there, and a public limited company which is not listed on the stock exchange, that also can be there, no? We are not talking about listed or unlisted there. We are talking only about a closely held company. Company can be a private limited company also, company can be a public limited company also, but not listed. If it is listed, then the general public is having more shareholding. Who should have more shareholding? Some few private individuals should have more than 50% shareholding, meaning that the company is a company where I am having what? Substantial interest. Getting my point? Everyone? So tell me. Now, point number A, clause A, deemed dividend done. Clause B, deemed dividend done. Clause C, done. Clause D, done. You tried everything and you failed, because everywhere the company caught you that you can give dividend like this, you can give dividend like this. So now what you are doing? Now you are a shareholder in a company which is a closely held company, guys. Closely held companies can be a private limited company also, a public limited company also. But here the majority shareholding will not be with the general public. General public is not substantially interested. Majority shareholding is not with the general public. Majority shareholding will be with certain private individuals. Meaning, we all can have a public limited company, yes, and in that public limited company we all are having what? Majority shareholding. So even that company can be treated as what? A closely held company. Private limiteds are always closely held, but even a public limited company can be treated as what? A closely held company, provided in that company majority shareholding is not by general public. Okay, majority shareholding is by few individual people like us. Can be relatives also, can be friends also, can be known people also, but not the outsiders, but only people who are us. They have majority shareholding. Substantially interested. Public? No. We are substantially interested. Got it, sir? Tell me. Now this company giving loan advance to the shareholder, deemed dividend. This company giving loan advance to a concern where the shareholder is having substantial interest, then that loan advance will also be treated as deemed dividend. And this company paying for the benefit of the shareholder, any liability paid, any personal expense of the shareholder paid by the company, that will be also treated as deemed dividend to the extent of accumulated profits as on the date of giving the loan or advance. As on that day, whatever reserves and surplus will be there, accumulated profits will be there, to that extent only it will be treated as deemed dividend. Will you remember? What if that loan advance given to a concern where the shareholder is having a substantial return, then also deemed dividend? What if the closely held company pays some amount on behalf of shareholder? Hello sir. Then also it is a deemed dividend. Will you remember? Everyone, 222A to E done. Okay, no? Now come to F. Now you read this. I'll not explain because I've already explained this part with capital gain chapter. Please read it. Today only one phase of electricity is there at my house. One phase is gone and it is going and coming, going and coming. This is happening since afternoon only. I took the first lecture in the morning. It was okay. But since the afternoon, no, they are switching on one phase and switching off the second phase. Some maintenance work they are doing. I don't know what maintenance work they are doing since very long time. Okay, tell me. Buyback price given by domestic company to shareholder for buyback of shares. Okay. If this buyback price is given on or after 1st October 2024, then the entire buyback price will also be treated as your deemed dividend under section 222F. Do you remember reduction of capital happens and the distributions are made? That is also deemed dividend to the extent of accumulated profits, whether capitalized or not. Yes or no? So that is also a deemed dividend. But there they used to say that any distribution on buyback of the share is not treated as redeemed dividend under 222D. Because in buyback also what happens, the capital gets reduced and the distribution is made. Buyback price is given, yes or no? So in buyback also the capital is reduced and the distribution is made. That will not be treated as deemed dividend under 222D. They were telling this up till now. But now that buyback, capital reduction on buyback will happen and you are going to get some money as your buyback price, yes or no? Even now from 1st October 2024 onwards, now this will be treated as what? Deemed dividend. Earlier 115 QA was applicable, company used to pay tax on this. For shareholder it was fully exempt under 1034A, but from now onwards company is not liable to pay any tax under 115 QA. For shareholder also it is taxable amount. For shareholder also they cannot get 1034A exemption. For them this will be taxable amount. But don't tax this as your full value of consideration under the head capital gains under 46. Hello sir, 46A. Rather consider that amount as your deemed dividend. No deduction for any cost will be allowed. Remembering or not, I don't know. No deduction for any cost will be allowed. And the entire amount will be taxed as your normal income under the head IFOS as your deemed dividend. So accordingly, this was nothing but the amount coming to you by surrendering your shares because they are being bought back. So this should have been your full value of consideration under capital gains side. So will you calculate capital gains now? Yes. Still this amount is getting taxed under IFOS as what? Deemed dividend. Still this amount will be treated as what? Full value of consideration under 46A. But when you will take it as a full value of consideration, the one amount is getting taxed twice, no? So government wants to charge here only. So there the full value of consideration will be ignored. This amount, buyback price, will be ignored as a full value of consideration. Take nil as full value of consideration. And minus the cost of acquisition there. Cost of acquisition of shares will reduce from there, not from here. Getting my point? So here it will be your normal income. Here it will be your normal income, can be taxed at highest rates, 30%. But if that would have been taken as your full value of consideration for sale of what? For transfer of shares in the liquidating company, then this amount would have been treated as taxable under the capital gains, but would have been taxed only at 20%. If we wanted to take 20% only from you, then it was better to take 20% under 115 QF from the company only, no? This entire thing I have explained properly. I hope you remember this. What is the logic and what will be the tax treatment? Will you be able to do it? No, I don't believe you. No, I don't believe you. No. You will solve one question. Only then I'll believe you. Only then I'll come to know that no, now you are okay. Now you are comfortable. The same concept can be asked in exam in this way. See, I am showing you. .493. This is Mr. B. He bought 100 shares of A Limited. Okay, no? If nothing is mentioned, we'll consider that the shares are unlisted. Okay? Now 100 shares of A Limited, at what price he acquired? 40 per share. 40 only, no? So total cost of acquisition is how much? 100 into 40 is 4,000 rupees. Total cost of acquisition. This is cost of acquisition, which is nothing but actual cost. 4,000 rupees. Now what is happening with these shares? They are saying that out of these 100 shares, 20 shares are bought back in November 24 at 60 per share. So out of this 100, no, 20 shares bought back. When did this happen? November 24, no? November 24. Can I say on or after 1/10/2024? On or after 1/10/2024, 100 shares are out of 100. 20 is only bought back. Huh? What was the cost of these 20 shares? 20 into 40. 20 into 40, 800. Hello. So 800 was the cost of acquisition. Against that, how much he is getting? Buyback price 60 per share into 20, 1200. Yes or no? Now pay attention, this rupees 1200 which he is receiving as buyback price, this was his cost of acquisition. Okay. Out of, if this was done prior to 1st October, what would have happened? Tell me. On this amount, the company would have paid 20% tax under 115 QA, and this amount would have been fully exempt in the hands of Mr. B. But since it is happening on or after 1st October 2024, now there is an amendment. Now the company A Limited not liable to pay tax under section 115 QA. This is the first point. Second point, exemption under section 1034A not available to Mr. B. And 3, this entire buyback price, entire amount of rupees 1200 shall be treated as deemed dividend under section 222F. Sure, sir? Pay attention now. Capital gain under section 46A will also be calculated. But to calculate this, FVC buyback price rupees 1200 will not be taken now. FVC has to be taken as nil, because that entire 1200 got taxed under the head IFRS. Yes or no? Now what will be the cost of acquisition of these shares? Actual cost, which is nothing but 20 shares multiplied by 40 per share is equal to rupees 800. Now from nil, if you reduce 800, you will get capital gain or capital loss? Capital loss. Now this loss is long term or short term? Long term. Why? These shares you acquired in, when did you acquire? Not given. But whenever you have acquired, okay, no? Date of acquisition is not given. Oh, it is given in 2020. See, no, 2020. So you acquired these 20 shares in 2020, and they were taken away from you in November 24. 2020 to 24 will be more than 24 months only. So the shares were long term. For that, the full value of consideration will be taken as nil. Cost will be reduced without indexation, because the transfer is happening on or after 23rd July. Yes or no? So the entire amount of cost will be reduced without indexation, but the resulting gain or loss will be long term only. So therefore there will be a long term capital loss of rupees 800 here shall be allowed as set off from LTCG only, because long term losses can be set off only against long term gain. I have already told you. If not, then allowed to be carried forward. Did you understand? Now, what is happening about the other shares? See, 1200 deemed dividend. Okay, 800 is your loss. Okay. Number of shares sold in December 25 by Mr. B at 70. December 25 next year, not this year, next year. How many shares? Bought back by A Limited, huh? Hmm. Price received, sale price. Sale price is how much? 70 into 50 rupees 3,500. Now this will be taken as your full value of consideration. Based on this, the capital gain, long term gain of these 50 shares will be calculated. Yes or no? So minus cost of acquisition only I'll do. 40 rupees per share for 50 shares. Rupees 2000. Therefore, long term capital gain will be rupees 1500. Now, did you have any loss? How much? 800, no? And now you have any long term gain? Yes. So, against that gain, the loss can be set off. Yes. So, set off of long term capital loss of 20 shares, which you calculated under section 46A. Yes or no? How much? Rupees 800. So now only rupees 700 out of this will be taxed. Instead of taxing 1500, we'll tax 700 only. But later on, when you'll sell the shares, when you'll get the capital gain, from that the loss will be adjusted. But 1200 which you are receiving right now will now be taxed in the form of deemed dividend only. You cannot charge that under the head capital gains. Done, no? What about the balance number of shares? How many shares? Still held by Mr. B. No effect to be given for these shares. Whenever they will be sold, that time the capital gain will be calculated or bought back. Then the effect will be given which we give for the first 20 shares. Same effect will be given that time also. Got it, sir? This type of question can come as a case study, MCQ case study, or independent question can also be asked for 4 to 6 marks like this. Shall we move ahead? With this, the concept of dividend is over. Concept of dividend done. Sure, sir? Now the second income. See, in that list of specific charge, first income we wrote dividend. It is the biggest discussion in the IFOS which we have completed. Now all the discussions will be very small except for this winnings and one more discussion we are going to do, gifts. Winnings, gifts, and one more discussion we'll do about the life insurance policies. So 2-3 discussions are still very interesting, and we have to get into details, we have to get into the depth. Apart from that, all the things are very easy. We'll start, we'll end, we'll start, we'll end, just like that only. Okay, so now we are having the discussion of casual incomes. See, sometimes you get involved into some casual activities like buying lotteries, playing crossword puzzles, then races, you are, gambling in races, including horse races, you are playing card games, other games of any sort, gambling you are doing betting. All such activities are known as casual activities. People usually do these type of activities to make themselves, to entertain themselves. See, this activity will be done sometimes only by majority of the people. Very few people are there whose bread and butter comes from this activity, who consider this activity to be their main business. Consider whatever you want to. Under the Income Tax Act, all the casual activities, any income by winning in such casual activities will also be taxable only and only under the head IFOS as your winnings income. Because see, there are two chances here. Either you win or you lose. If you win, something will come. If you lose, whatever you have, gambled will go away. So if you lose, there is a loss. And if you win, there is a huge amount coming to you. Getting my point, everyone? So, any income arising from these casual activities will always be taxable as your income from other sources. This is given in 56(2)(1)(b). Always your IFRS income. We cannot charge this income under any other head except for IFRS. That's it. So when you win, you get some winnings. When you lose, it is a loss on such activity. Done? Now pay attention. If you win, you will get money, you will get income. What will you do with that? 2(1)(b) says that it will be taxable, but it will be taxable fully. What did I say? It will be taxable fully. Fully means, sir? Fully means the entire amount of winnings will be liable for tax. So bring that entire amount of winnings under the head IFOS and charge here only. But remember, when you will charge this income under the head IFOS, no deduction under the head IFOS will be allowed. And for doing such activities, while doing such activities, in the course of doing such activities, some amount you might have lost also. That would have been your loss. So the losses incurred at the time of, doing these activities, those losses will also not be allowed as a deduction. So there is no deduction for expenses or losses which you can claim from this income. This income, entire income will be taxable. Full amount will be taxable. So in your IFOS, will you include this entire amount as taxable income? Yes, always. Now this entire amount, out of that amount, can you set off any loss? Under the head IFOS, there is some source of income which is giving you loss. Can you adjust that loss against this winnings income? The answer is no. From your winnings income, no expenses, no losses incurred in the course of in the course of such activities, no deduction for such expenses and losses. And once you charge the entire amount under the head IFOS, from this amount, whatever losses of other sources under the same head or from the different heads, whatever losses are there, those losses from other heads or also from the same head, some losses might be there. Any loss, none of the loss can be adjusted against this winning income. No set off of any loss is available from winnings income. Will you remember this? Close your eyes and try to think. Try to, remember all these things, because these things are very important. You have to remember all these things. So first of all, think. I am doing some casual activity. Can I win there? Yes. If I'll win, I'll get some huge amount as my winnings. If I lose, then I'll lose. whatever I have, put in that, whatever I have invested in this activity, that will be gone. For example, I have taken lottery tickets. If I don't win, the money is gone. If I have gambled some amount, if I'm playing card games, so whatever amount I am, gambling, entire amount will go if I lose. But what if I win? Whatever I have given will come back with huge amount together. Getting my point? Now, whatever you lose, as well as whatever you spend to earn this type of incomes, will never be allowed as a deduction. Entire amount shown taxable. Against this income, no losses can be set off, meaning that entire amount which you will show under the head IFOS will go to your GTI, because there is no set off of any loss also available. And that entire amount which is shown in your GTI, from that you are not going to get any deduction under chapter 6A. Chapter 6A deductions are also not available, meaning if in your GTI, if in your IFOS you will show this, no loss, no expense can be claimed as deduction. Further, no losses can be set off against this income, meaning that entire income will be shown in your IFOS, will be shown in your GTI also. Now from your GTI, separate these incomes. You are supposed to show this entire income taxable under the IFOS head. Getting my point? Sorry, entire amount taxable in your total income. So you had a winnings of 50 lakhs. Where will you show? IFOS. Can you claim any expense or loss as a deduction from this 50 lakhs? No. Entire 50 lakhs taxable under the head IFOS. Any loss of IFOS head or any loss of any other head cannot be set off against this 50 lakh rupees. Hello, sir. So that means entire 50 lakhs will be shown as your income in your GTI, no? Gross total income. Now from your gross total income, you are supposed to take chapter 6 deduction, but that chapter 6 deduction is not available from this part of gross total income, which was your winnings. So separate this part of gross total income. You will have to show this entire amount in your total income. So in your total income, your full winnings will go, because no deduction, no set off, no chapter 6A, full winnings will go in your total income. And from your total income, separate this winnings, because you are supposed to pay flat 30% tax on this winnings. Will you remember these treatments? Sure, no? The same concept which I am discussing right now is applicable in the case of online money gaming. Winnings from online money gaming. Online money gaming apps and all, na, MPL is there, Dream 11 is there, hello, Rummy Circle is there, Jungly Rummy is there, Winzo is there. They are what? Online money gaming platforms. So there also you play and win. So whatever you will win from there, no, from online money games, even those winnings will be taxable under the head IFOS, like this only. Everything which I have discussed for these winnings will be applicable as it is for what? Winnings from online gaming. But the only difference is the rate of tax for such winnings is prescribed in rate of tax will be prescribed in 115BBJ, and on all the winnings it is 115BB. Winnings from online gaming 115BBJ, which talks about the same thing, 30% and all. Yes or no? Only the section number has changed. Where you will charge these incomes? Only under the head IFOS. Even if you are doing such activities on a regular basis, incurring such losses on a regular basis, getting such winnings income on a regular basis, we don't care. Entire amount you are supposed to charge. Getting my point? Everyone? Now pay attention. Last point. Second last point, in fact. See, whenever you will get the winnings, no, there will be a TDS which will be deducted from your winnings by the person who is paying that winnings. TDS rate is 30%. The amount of tax which you are supposed to pay on the winnings will be entirely deducted, from your winnings, and only the 70% winnings, meaning the net winnings, you are going to get in your hands. But for that, section 194B and section 194BB are applicable. This section says that whenever the payer is paying the winnings and the amount of winnings paid by him is more than 10,000, on the entire winnings the payer is liable to deduct TDS. At what rate? At the rate of 30%, because that was the rate at which you were supposed to pay tax. Why there is a TDS provision here? Why? Because see, if we will wait for the assessment year to come, that okay, the assessee has won, no, this year, let him enjoy, let him do the party, let him go and roam around the world, okay, and once he'll come back, assessment year will come. In the assessment year, on the entire winnings he is going to pay tax. By the time assessment year will come, no, you would have spent your entire winnings income, because the moment you get such kind of incomes, no, you try to fulfill all your desires and dreams. You'll buy a car, you'll buy a house, you'll get married, and you will spend this money with both of your hands without even stopping. Now during the previous year, if there are winnings, and those winnings are prone to be spent fully during the previous year itself, then why to wait for the assessment year to come to charge and collect the tax on this? Because charging and collecting the tax on this income in the assessment year will delay the tax collection, no? Or what if the tax is not given only? Assessee vanished. So it is always better to tell the payer to deduct the TDS and give the balance amount of 70% to the winner assessee, who is the winner. Yes or no? So the entire amount will be deducted, no, as a TDS, or only 30%, only 30. 70 will come to you. How much will you show taxable under the head IFRS? Come on, tell me. Entire gross amount you are going to show taxable, no? Apply the same logic which you applied in the case of salary. Do you remember salary? TDS is deducted. Do we tax the net salary under the salary or gross salary? Gross. So we add the amount of TDS in the net salary. The salary becomes gross, and that gross salary is charged to tax. Same thing you are supposed to do here. If net winnings are given, what will you do? You will calculate the 30%. Can you calculate 30? Yes. If net amount is 70%, is this much, then how much should be TDS? 30%. Cross multiply, you will get the TDS amount. That TDS amount plus 70% amount, both taken together, will be a total amount. And that total amount, friends, will be, yes, got it, sir? Now pay attention. That total amount will be taxable as your IFRS income. But in that total amount, are you showing this TDS amount as your income only? No. Meaning that first show the entire amount as your income. Don't take any deduction. Don't take any set off. Don't take any chapter 6 deduction out of that amount. Getting my point? Now that entire amount will be shown as a part of your total income. Separate it. Apply 30% tax rate and calculate the tax on that. Now that tax which you have calculated plus your other taxes on other incomes, both taken together, you will get tax on total income, and from that you will get the credit of this TDS deducted from your tax liability, which you have already shown as your income. This much tax you have already paid on some part of your income which was winnings income, no? So this much tax you have already paid. Then take the credit. Getting my point, sir? Sure, sir. Pay attention. 115 BB talks about winnings. 115 BBJ also talks about winnings. But that is online money gaming. And from online money gaming, whatever winnings you are having, on that also the TDS is deducted. But that is given in 194 BA, newly inserted section. Last year only this provision has come. Now as per 194 BA also, the TDS is deducted from your winnings of online money gaming. Yes or no? So after reducing the TDS, whatever amount is there, that you are getting paid. Hello sir. That you are getting paid, no? How much amount you are getting paid? The amount of your online money gaming winnings minus the TDS, that balance amount you are getting paid. What you will do? Add TDS amount which was deducted under 194 BA. You will have gross amount of winnings you will show taxable. From that, no expense deduction, no loss set off, hello. Then no chapter 6 reduction. The balance amount which will remain will be fully taxable. That full amount is fully taxable, will be shown as a part of your GTI, and that same amount will be shown as a part of your total income. Separate it from the total income. You are supposed to calculate 30% tax on this. Ayyo, very difficult, no? Difficult or understanding everything? Okay, then wait, one more small thing I will say. Under section 194 BA, no, the TDS is deducted whatever is the amount of winnings, the TDS will be deducted. But under section 194 B or BB, TDS only if the amount exceeds 10,000 winnings. So the amount of winnings, is it more than 10,000? Yes. Then on the entire amount the TDS is deducted. Here there is no monetary limit. Meaning whatever online money gaming winnings you are getting, no, on that flat 30% tax will be deducted. But the tax will not be deducted on the amount contributed to participate in the games. Because see, whenever you will participate in online money gaming, no, so you will download one app or on the website you will go. You will create one account, user account and password. And once you create and once you log in, no, a page will open. Different games. Which one you would like to play? So you will click on one game. For example, Ludo. You want to play Ludo. Okay, play Ludo, no problem. Now tell me, if you open that account in that app or in that site, you are going to play some games, online games on that site, would that site or application charge you some amount to participate in that game? Yes. So for that, what you'll have to do, first you'll have to deposit some amount. In what? First of all, you will have to deposit some amount. Where? In that account, in that online money gaming account. Once you deposit that amount, from that some amount will be used to participate in that game. That amount is your participation fees. Now pay the participation fees, play the game, and then if you win, okay, now, so what happens? One account will be opened. In this account, you will put some money. For example, 5,000 rupees you have invested. 5,000 rupees you have put that in that account, online money, online gaming account. Out of this 5,000, you took 4,000 rupees to participate in a game. One game was there, game you participated. By this game you won 10,000 rupees. Possible or not? Now that 10,000 will again come to your account only. Now your account will show how much? 10,000 plus 1,000 which is remaining. So 11,000 will be there. Out of that 11,000, don't you think that the 1,000 which is there was your money only which you have? That is not your winnings. Sure, no? Now the 10,000 was your winnings. But in your online money gaming account, it will be 11,000 balance. Now, whenever you will withdraw that amount, no, that time some amount will be charged. Platform fees, this fees, that fees, to withdraw that amount from the account. Getting my point? So whenever you will withdraw that amount, these deductions or reduction in your winnings will happen. After eliminating all such nuisance, net winnings will remain. On that the TDS will be applied, 194BA, 30%. Will you remember this much? Sure. So this was your winnings. Okay. I hope you understood everything. See, we were discussing about this TDS also on winnings, no? So what is the rate of TDS? Come on, tell me. 194B and 194BB. If the amount of winnings is more than 10,000, TDS is deducted at the rate of 30%. Right now, TDS is deducted at the rate of 30%. Very good. Now tell me, 194BA, is there any monetary limit? Monetary limit? No. The net amount of winnings after deducting charges and all. On that net amount of winnings, entire net amount of winnings, 30% TDS is charged. 30% TDS is deducted. Yes or no? So there is no monetary limit. Full amount of net winnings. Net winnings means the amount which is remaining in your account after reducing the charges for that platform fees and all. Yes or no? On that full amount, 30% is TDS. Now see, when the winnings is given in the form of money, no, that time the TDS can be deducted. Sure. So for example, 100 rupees was your winnings. 100 was winnings. 30 will be TDS. So 70 will be your net winnings. So this is gross, this is TDS, and this is net. Gross was, for example, gross amount was 1 lakh. So from that the TDS will be 30%, 30,000. So 70,000 will be your net winnings. Under the head IFOS, how much winnings you are going to show as your taxable income? Come on, tell me. Under the head IFOS, how much amount you are going to show as your taxable amount? Net or gross? Always the gross. Yes or no? So this 1 lakh will be shown as taxable, as income from other sources. This 30,000, take the credit from tax liability. So from your final tax liability which you will calculate, from that amount you will take the credit of 30,000 TDS. Okay, no? This 70,000 is in hands winnings. Sometimes the payer, he tells you that how much is your winnings? 1 lakh. Okay, no problem, take this 1 lakh. I will not deduct any TDS. So he tells you that he is going to pay you the entire amount of winnings without any TDS reduction, without any tax reduction. Is it possible? Yes. You participated in some TV game show and you won in that TV game show. So the organizers, the TV game show organizers, they told you that entire 1 lakh we will give you. Don't worry. We will not deduct any TDS. Tax we will pay from our pocket. See, whenever some amount is released by the payer as winnings, government always thinks that the tax is already deducted by the payer and this amount is released. So 70,000 was released, no? Tax is deducted and 70,000 released. So that 70,000 is 70%. How much is 30%? 30,000. Getting my point? But it can also happen, no, that the amount of winnings released was the full amount of winnings which the payer promised. So the moment he'll say that 1 lakh rupees winnings is there, don't worry, will not deduct 30, will not give you 70, will give you the entire 1 lakh rupees to you. Government will always think that whatever amount released as winnings is after TDS. Winnings was some amount. Out of that TDS deducted by the payer and 1 lakh is released. So this 1 lakh is not 100%. Now that 1 lakh is 70%. Understanding? So now you will do gross. Tell me, gross, TDS and net. Gross is 100, net is 30, TDS is 30 and net is 70. Now tell me, if the organizer or the payer who is paying you winnings, he says that he will pay you 1 lakh, full amount of winnings he will pay. So that 1 lakh will be released to you. That 1 lakh should I write in front of that 100 or in front of this 70? In front of this 70. Because the government is going to think that 1 lakh is, the payer is giving 1 lakh, meaning some winnings is there. Out of that 30% he has deducted. And he is releasing 1 lakh. Getting my point, sir? So if this 1 lakh is 70%, how much should be this 30? Can you cross multiply? Cross multiply. No, not give me the exact amount. 42 something 527 or something like that. 857, yes. 42 857. Meaning that the government thinks that the winnings was not 1 lakh. Winnings was 1,42,857. And now the recovery of TDS will be made from that payer. So the government will ask how much to pay? 42,857. Getting my point? So now this amount will be gross amount will be your taxable IFRS income, because you always show gross amount as your taxable. Yes or no? This amount will not be deducted out of your gross amount, but this is paid by payer on behalf of winner. So on behalf of the winner, this amount will be paid by the payer, and the winner will get this amount in hands. So if you are a winner, how much amount you will show taxable as your IFRS income? 1,42,857. Meaning 1 lakh coming in your hands is also your benefit given by the payer, and 42,857 your tax he is paying from his pocket is also your benefit. So how much is your total benefit? 142,857. Show that amount as your income. And see, whenever you will finally calculate your tax liability, in the tax liability take the credit of this amount paid on your behalf. Take the credit of this amount. Getting my point? So this can be, this can be asked in any of these ways in the exams. Majority of the time they ask this one, red color, but even the black color can be asked. The second way can also be there in the exam. Whenever there is a TDS, always gross up the amount and charge that gross amount taxable. In that gross amount, always show TDS as your income. Yes or no? And later on, when you will calculate the tax liability, you will get the credit of that TDS, which you are showing right now as your income. Getting my point? Sure, sir. Should I move ahead? Now, this can be done if the winnings is given in cash. What if kind winnings given? Payer is giving winnings in kind. For example, a motor car is given whose fair market value was 10 lakh rupees. Can it be given? Is it more than 10,000? Yes. See, if the winnings amount is more than 10,000, TDS has to be deducted. Yes or no? So is the winnings amount more than 10,000? Yes. So TDS has to be deducted. So how the TDS will be deducted out of this? 2 wheels will be taken out, music system will be taken out, 1 seat will be taken out, the material worth 3 lakhs will be taken out of the car, the remaining car will be given, and this material which is taken out of the car, this material will be given to the government. See, government, TDS. Will you do something like that? That cannot be done, no. So in this case, how the TDS will be deducted? See, the person to whom the winnings will be given, winner, also known as payee, he will be asked to deposit. He will be asked to deposit what? Deposit 3 lakh rupees as what? Tax to the government. You are winning a car worth rupees 10 lakhs. From that we are supposed to deduct TDS of 3 lakhs. We cannot deduct 3 lakhs out of car. Go and pay 3 lakh rupees to the government. That is your TDS, which you yourself pay to the government right now. Okay? And show us the proof that you have paid 3 lakh rupees as what? TDS. And take the car from us. Then the net will be 7 lakhs. Hello, sir. Net will be 7 lakh. 3 lakh tax you have paid. Hello. So your gross winnings will be 10 lakhs. Show that 10 lakhs as your IFRS income. In that 3 lakh also shown, no? Do one thing, take the credit of this 3 lakh later on. Can you do it? But wait. If the payee does not deposit the tax on its own and payer decide to bear it, then this 10 lakh will be treated as 70%. Cross multiplication will be done just like this. Will you be able to do it? Sure, sir. This is the end of winnings. Okay. See, this is the end of winnings. So winnings income, out of all the incomes which are taxable under the head IFOS because of specific charge, one was a dividend that we completed. All the dividends we have completed, yes or no? All the types of dividend we have completed. We have completed the entire discussion, important things to be remembered while charging the dividend to tax. Then we saw winnings income also. Okay, and after winnings we are going to see now other incomes. Okay, but wait, I had some doubt. One small point I forgot to discuss with you along with dividends. See, I told you that if there is a closely held company who is paying loan or advance to its shareholder holding greater than equal to 10% shares in this company, yes or no? So that loan or advance is what? Deemed dividend under section 222E. But for this thing to happen, the closely held company, its substantial part of business should not be to give loans or advances. See, if you are into the business of granting loans and advances, just like others, he is also coming to you and you are giving loans and advances. That will not be treated as deemed dividend in the hands of shareholder, yes or no? But if your business is not to give loans and advances, and still you are giving this loans and advances, then it is treated as deemed dividend in the hands of the shareholder. Okay, no? So for example, the main business of this closely held company was manufacturing business. Example, the company was doing a manufacturing business. Meaning that the substantial part of the business of the company is not granting loans and advances, and this advance is not given in the course of business. Then whatever advance was given, for example, 5 lakh rupees of advance is given, loan is given. So that 5 lakh rupees will be treated as deemed dividend in the hands of the shareholder. It has already suffered tax in the hands of the shareholder now. Okay, no? Now later on what happens, after the shareholder has got this advance, after the shareholder has got this loan advance, and after it is taxed in his hands as what? Deemed dividend, later on the company is giving the normal dividend, final dividend or interim dividend is given. So just like other shareholders, this shareholder will also get his dividend. So from this closely held company, now later on, closely held company, the same company giving to the same shareholder, now the normal dividend will be given. Now just like other shareholders, this shareholder is going to get his normal dividend. So the amount of normal dividend, meaning final or interim dividend, which the shareholder was supposed to get was 8 lakh rupees. How much? 8 lakh rupees. But what this company did, out of this 8 lakh, this loan or advance, this was adjusted out of this. And after adjusting only, 3 lakh dividend was given to the shareholder. Possible or not? Now, second time, if you will say that the shareholder is getting 8 lakh rupees as dividend and 8 lakh if you will charge, don't you think that the 5 lakh will be taxed for the second time? Hello sir, if that 5 lakh rupees loan advance, which is already considered as your dividend, is now getting adjusted out of your normal dividend, so treat the balance normal dividend only as your dividend now. Don't treat the entire 8 lakh as your dividend income. If you will treat the entire 8 lakh rupees as your dividend, no. What will happen? That 5 lakh which has already got taxed earlier as what? Deemed dividend, that 5 lakh will be again charged as dividend. Will be taxed twice. So if that 5 lakh rupees loan advance is adjusted later on out of your normal dividend, no, reduce that amount. After reducing that, whatever balance dividend remains, no, that dividend only will be treated as income in the hands of the shareholder. But what if it was not later on adjusted? Entire 8 lakh was given then? Then entire 8 lakh will be your entire 8 lakh will be your dividend. Will you remember? This last point I forgot to discuss at that time. You will keep this thing in mind. Okay? Now come to question number 1 in your ICI study mat. Rahul, a resident Indian, holding 28% of equity shares in a company. So Rahul is a shareholder. He is having 28% shares in a company, meaning more than 10%. So write down greater than equal to 10%. Took a loan of rupees 5 lakh from the same company. Oh my god, loan is taken from the same company, 5 lakh rupees. So if that company is a closely held company and the substantial part of the business of the company is not granting loans and advances, then this loan can be treated as deemed dividend in the hands of Rahul. But it will be treated as deemed dividend only to the extent of accumulated profits. Yes or no? Now, on the date of granting the loan, the company had, on the date of granting the loan, the company had accumulated profit of 4 lakh. Accumulated profit of 4 lakh. The company is engaged in some manufacturing activity, meaning the substantial part of business is not granting loans and advances. Yes or no, sir? So now, is the amount of loan taxable as deemed dividend if the company in which the public are substantially interested? If the company is company in which the public are substantially interested, then the loan given by the company will not be treated as deemed dividend in the hands of the company, in the hands of the shareholder. So write down no. Such loan not treated as deemed dividend under section 222E. Why not treated, sir? Because the company is not a closely held company. Write down. Since company not equal to closely held company. Okay. Now the second case, they are saying not a company in which the public are substantially interested, meaning now the company, since company is a closely held company, who is giving loan to Rahul, who is having greater than equal to 10% shares in the company. Yes or no? Then this loan of rupees 5 lakh will be treated as deemed dividend. But it will be treated as deemed dividend only to the extent of accumulated profits and not the full amount. Accumulated profits was only 4 lakhs. Will you be able to write down the answer? Don't worry, this type of questions don't ask. Okay. Now, let's move on to the next income. And I don't know whether you will recollect this thing. But we have already done such income under the head PGBP. If you remember, we did this section 36 subsection 1 clause 5a. That time also I told you that this similar type of income, same type of income will come in IFRS. This is in front of you. Simple. If you are an assessee, you have some employees. So will you pay them salary? Yes. From their salary, you are deducting their contribution to staff welfare fund. Meaning employees' contribution to staff welfare fund has to be deducted from their salary. So whatever amount which you have deducted from their salary, it is their contribution. It is employees' contribution to their own staff welfare fund or scheme. You are contributing separately. That is your contribution, your expense. But employee also has to contribute, no? So the amount which is supposed to be contributed by the employee, he will not directly contribute. So you will have to deduct from his salary. So the moment you deduct this amount out of the salary of your employee, it becomes your income. And since you were not doing any business or profession, this amount cannot be taxed under the head PGBP as your income. So do one thing, bring this amount under the head IFRS. Now this income will not be your PGBP income. Now the amount deducted from your employee's salary, now the amount deducted out of your employee's salary as employee's contribution will now be treated as your PGBP income. No, for you it will be your IFRS income, 56 subsection 2 clause 1c. Because you are not doing any business or profession. So if the amount cannot be taxed under the head PGBP, then this amount has to be taxed under the head IFRS. Getting my point? Now the amount which you have deducted, that amount is already considered as your income. Now you deposit that amount in the scheme, staff welfare scheme, staff welfare fund of the employee, yes or no? Then that amount which you have deposited out of this income will be allowed as a deduction under section 57 under the head IFRS. Because the income was taxed under the head IFRS, from this income whatever amount you have deposited will be allowed as a deduction under the head IFRS only under section 57. But make sure you deposit this amount on or before the due date of that fund, of that scheme, not the return filing due date. Yes or no? So this amount has to be deposited in the staff welfare scheme, staff welfare fund on or before the due date of that fund, on or before due date of that scheme. Only then the amount which is considered as your income taxable under the head IFRS will be allowed as a deduction. Will you remember? One more income done. Now all the incomes are very small incomes. Now see, because of specific charge, we are doing specific charge only. So under the specific charge, this interest is taxable under clause 1D. So along with this, I have also covered one more interest which is getting charged under the head IFRS only, but because of specific charge. But that charge is given in clause number 8. So two interests are taxed under the head IFRS because of specific charge. One as per clause 1D and second as per clause 8. Both these interests we are going to cover here. Together only, discuss all the interest together at one place. So you don't have to go here and there. All the interest discussion at one place only. But here I will tell you some more interest will be taxable under the head IFRS, not because of specific charge but because of general charge. Can you see this general charge? See, this interest is also taxable under the head IFRS, but not because of any specific charge. Because of general charge, it is getting taxed here. So this interest will be taxed under the head IFRS because of specific charge, and this interest will be taxable under the head IFRS because of general charge. and there is some interest income. There is some interest income which is not chargeable only, which is not taxable only, fully exempt. So I will tell you the list of that interest income which is fully exempt. Hello. If you get any of this interest, no need to charge under IFOS, no need to charge under any other heads. This interest itself is fully exempt under section 10(15). So let us do that interest also together. So all the interest part is, covered at once. Can you see the first interest, this one? Read. This is interest on securities. Do you have any securities? Bonds, debentures, government securities. It does not include shares, because on shares the returns come in the form of dividend, which we have already seen. Other than shares, all other securities. So are you holding the securities as your stock in trade of business? Yes, because you are into investment business. Your business is to buy, sell securities, on the return on securities. Your business is to buy and sell of the securities and earn the return on securities. That is your business. So in the course of that business, whatever securities are bought, they are your stock in trade. And on those securities, if you are getting any interest, that interest will not be taxable here. It will be taxable under the head PGBP. But if you cannot charge that interest under the head PGBP, there is a specific charge. 56 subsection 2 clause 1D. As per that specific charge given in 1D, if that interest on securities cannot be taxed under the head PGBP, then it will be taxed under the head IFRS only. Done. Will you remember? But first try to charge it under the head PGBP. Ask yourself, are you in the business of buying and selling of securities, holding them and earning interest therefrom? Are you in the investment business? Then the securities held by you is a stock in trade. Then whatever interest will come on that security will be charged under the head PGBP. Don't apply this logic. This logic cannot be applied for dividends. Even though the shares are held as stock in trade, still the dividend on those shares will be taxable only under the head IFOS. Yes or no? But here, if the securities are held as stock in trade, interest on such securities will go to PGBP. If not there, then you can bring it under the head IFRS. Only then the charge is there under the IFRS head. Getting my point, sir? So, this was your note number 1. Please read. If the securities are held as investment and any interest on such security will be coming, that means the securities interest is not getting charged under the head PGBP. You are not in investment business. You are not in buying and selling of securities. So the security is not your stock in trade. And on this security, the securities is your stock in trade. You are in the business of buying and selling the securities. So if the securities are your stock in trade, on that whatever interest will come, go to PGBP. But if you are not in this business, and the securities you are holding, that means you are holding the securities as your investment, as your capital asset. On that securities, if the interest is coming, it cannot be charged under the head PGBP. It will now be charged under the head IFRS. Will you remember this? Sure, everyone? Perfect. This was your note number 1. And we have completed one interest. Now coming to the second interest, this one. This interest is also getting taxed under the head IFOS only. Do you remember that compulsory acquisition takes place of a capital asset? So there was one capital asset which was compulsorily acquired under any law. So are you going to get the compensation for that? Yes. That is your capital gain income. But if you are not happy with the compensation, you filed a case and you won the case, compensation was enhanced. So now you are getting the enhanced compensation. Even that enhanced compensation, after taking the deduction for litigation expenses, is allowed under the head, is taxable under the head capital gain only as your capital gain income. Hello, sir. But sometimes what happens? No, compulsory acquisition taking place right now. So today only you are not going to get the compensation. Today only you are not going to get enhanced compensation. For you to receive that compensation or enhanced compensation, it will take some time, maybe few years. So what happens whenever the compensation the government will give, or whenever the court will order an enhanced compensation and the government will give the enhanced compensation, it is already, there is a lot of delay. So the government will always give you compensation or enhanced compensation with some extra interest. Getting my point? And that extra interest is not the consideration for transfer of your asset. Hence that extra amount, that interest cannot be charged under the head capital gains. Under the head capital gains, what will be charged? Consideration for transfer of capital asset. And what was the consideration? Compensation as well as enhanced compensation. That is the consideration for transfer of your capital asset. That will only go to capital gains. But with that consideration, if some extra amount comes in the form of interest, that extra amount of interest is not treated as the consideration for transfer of your capital asset. That cannot be taxed under the head capital gains. But the government wants to charge tax on this. Where the government will charge? Under the head IFRS. This interest will be taxable under the head IFRS only on receipt basis. What did I say? Receipt basis. Meaning that whatever interest you are getting in this year on compensation or enhanced compensation, that entire interest, what did I say? That entire interest will be taxable in this year only. You don't see that to which year that interest relates now. No need to pay any attention to your method of accounting, because to your method of accounting there are 3 exceptions. First exception is dividend. Don't check method of accounting while charging the dividend. Hello, follow section 8. Don't check the method of accounting while charging this interest under the head IFRS. This will always be taxable on receipt basis. So this year's interest received in this year, taxable in this year. Any earlier year's interest received in this year will be taxable in this year only. No need to check that to what year the interest relates to, what type of method of accounting you are following. For example, last 2 years interest you are receiving in this year and you are following mercantile system. Can you go and say the government, can you go and tell the government that government, see, last 2 years interest no is my last year's income, not this year's income. I will show only those incomes which belongs to this year, whether received or receivable. I will show only those incomes which are for this year, because I am regularly following mercantile system of accounting. You will be given a tight slap on your face if you say that. For the taxability of interest on compensation or interest on enhanced compensation, the taxability always happens on receipt basis. Please, whatever interest you have received in this year, no, whether that interest is for this year, whether that interest is for earlier years, that entire interest which you are receiving in this year will be taxable as your income under the head other sources in this year itself. Getting my point? But even the government knows that we are not doing the correct thing with the assessee. Because see, assessee never asked us to pay the compensation late. The compensation, late payment of compensation is happening because of our mistake. And because of our mistake only, we are going to give interest. And we know that in every case, there will be this mistake, and every case of compulsory acquisition, we are supposed to give extra interest. Yes or no? So every case, leaving that interest, it is better to charge tax on that interest every time. Hence, they have charged this amount under the head IFRS. But they also know that this interest should not be charged. This is not, assessee's mistake. This was our mistake, and which we are, paying in the form of interest. And first of all, this interest, this type of interest, the assessee is not going to receive this type of interest on a regular basis. This is a capital receipt. But still we are considering this as an income, charging under the head IFOS. This is wrong which we are doing. Even the government knows. Hence, what the government is saying, that before you come and tell us that government you are not doing the correct thing, before that only charge this entire amount of interest on receipt basis and take a 50% standard deduction under section 57. Deduction you will get out of this income under section 57, but that deduction will be standard deduction. How much, 50% of this interest will be allowed as a standard deduction. The balance 50% only will be charged. Meaning, before even you come and tell the government that you are not doing it correct, please don't charge. Hello, we are going to give you 50% standard deduction so that you don't even think to come here. Because we are not charging the entire interest, no, only 50%. Rest 50% we are allowing you as a standard deduction without even asking any doubt. Understanding or not? So if we are not asking you any doubt, we are giving you 50% straight, at least pay tax on 50%. No. Now even the assessees will not bother, because they are given 50% standard 50% standard deduction. Just imagine. But the government is really smart. Government thought that giving 50% standard deduction is still beneficial. Charging tax on half of the interest is still beneficial, rather than not charging tax on any income at all. Will it be good if we charge tax on nil income, or we charge tax on half of the received income? What is better? Half of the received income only? No. Is better than charging tax on no income. So let's charge this entire income under the IFRS, but take 50% standard deduction. That's it. Will you remember this? Sure. Go to one example, illustration. Sixth, illustration number 6. They are telling you to determine the tax treatment, discuss the tax treatment only. Okay, no? So whatever interest on enhanced compensation or compensation which you are receiving in this year, how much was the amount? 5 lakhs. Out of this 5 lakh, the interest for 2021 was 1 lakh 50. Interest for 21-22 it is 1 lakh 65. And interest for 21-22 it is 1 lakh 85. So for the earlier years, this interest relates to this year. That entire interest is coming in this year. Will it be taxable in this year? If you follow mercantile basis, then only this year's income is shown. Hello? So any of these incomes relates to this year? No. So you will say that I will not charge any of the interest in this year because I am following mercantile. No. Entire 5 lakhs which you have received in this year will be taxable as income in this year. Whether in that 5 lakh some interest relates to this year, then also taxable in this year. Whether that interest relates to earlier years, then also that earlier year's interest will be taxable in this year only. Sure. So what you will write? You will write this which I have written. Write it down. This is the tax treatment to be given. Write it down fast. Done, friends. Should I move on to the next income? Wait, we are doing interest only. We are doing interest only. But two interests are covered under the IFOS head because it is given in specific charge. Now, can any other interest be charged under the head IFOS because of general charge? Yes. If you have some money and you give that money to me as a loan, and on that loan, if I am giving you interest, is it your income? Yes. Is it exempt anywhere under section 10? No. Can you charge this interest under any of the earlier four heads? No, because you are not in the business of giving loans and advances and earning interest income. Yes or no? You are not in the money lending business. So this interest cannot be charged under PGBP. Not even under any other head. So which is the head remaining? IFOS. Because of general charge, it will be taxable under the head IFOS. Will you remember? Sure, sir. There are certain other interests which will be fully exempt under section 1015. Now we are going to discuss about these interests. Yes or no? Now one by one, these interests, the name of these interests will study. You have to remember that entire list which I am going to show now. See, note number 3, can you see? This entire interest. Everything you have to remember. All the names. Okay. So, read this part. Have you heard about gold bonds? Gold bonds. I had discussed with capital gains. So there were two types of gold bonds. Old gold bonds, 1977, 1980, 6.5%, 7% gold bonds, national defense gold bonds. The old gold bonds are not capital asset. If you transfer them, no capital gain arises, and any interest on those old gold bonds is fully exempt. So if you have invested in such specified investments or securities, see, they are saying that certain specific type of investments or securities, so on those specified securities and investments, whatever interest you will get, that interest will be fully exempt. So they are specifying the first type of investment, first type of security. They are saying that the interest on gold bonds, old gold bonds, will not be chargeable to tax because that interest is fully exempt under 10 subsection 15. But sir, there are new gold bonds also. Have you heard about it? New gold bonds. Sovereign gold bonds. In the definition of capital asset, it is not excluded, meaning it is still a capital asset. If it is transferred, capital gain will arise, and on that capital gain you are supposed to pay tax also. But transfer of sovereign gold bonds by an individual at the time of maturity or the redemption is not treated as taxable transfer. It is treated as exempt transfer. In that case, the capital gain cannot be calculated. But rest in all the cases, sovereign gold bonds transferred, capital gain will arise and it will be taxable also because sovereign gold bonds are capital asset. Now under 10 subsection 15, they have not given any exemption for the interest on such bonds. Meaning that whenever you will get the interest on such sovereign gold bonds, please request you not to exempt it. What you will do, rather you will charge that amount taxable under the head IFOS. Yes or no, sir? Will you remember? But wait. This was your first point. Second point. National. What word? National. National savings, annuity certificate. Invest money there. National savings, national defense, gold bonds. Invest your money there. National plan certificates, invest your money there. National plan saving certificates, invest your money there. So whatever amount you have invested in these government securities, on which whatever interest will come, that entire interest will be fully exempt. 10 subsection 15. Now if you will see, no, see, who will issue relief bonds? Government only. Who will issue special bearer bonds? Government only. Who will issue this treasury savings deposit certificate? Government only. Who will issue capital index bonds? Government only. Who will issue post office? Who will hold a post office account? Government. With the government only you hold a post office account in the post department. Yes or no? There are some notified bonds or debentures of these companies. See, if you will go and see this list, no, all the investments and securities which are specified in this section, everywhere you invest money, your money is, directly or indirectly going to the government. That means you are helping the government to mobilize funds. Your savings you are investing in these schemes, your savings you are investing in these type of securities, allows the government to mobilize the savings from the general public. So if you are helping the government to mobilize the funds, yes or no, by investing in these type of shares, by investing in these type of securities, so the government should give you some benefit. So compared to other investment opportunities, there will be higher rate of interest. First benefit you will get. Second benefit which you will get, second benefit will be what? You will get the entire income, interest income, which will be exempt. And why you will get it? Because the government will give you the exemption only then you are going to give the money to the government, no? So these are all the places where you invest money and the government gets that money. So the government would want you to invest more here. And if you will invest more, the more funds will be mobilized. The more funds will be received by the government. So the government should give you some benefit so that you get the motivation to invest here. Hence they are giving you what? Exemption. 10 subsection 15. So first bonds, did you understand? Gold bonds. Hello sir. Which bonds? Gold bonds. Did you understand gold bonds? Next one. National Savings Annuity Certificate. National Defense Gold Bonds. National Plan Certificate. National Plan Savings Certificate. Have I written etc. anywhere? Not written means only these four. Only these four you can purchase. So whatever amount you invest in their purchase, on that whatever interest is coming, that entire interest is exempt. But remember, the government also issues national savings certificates. Now see, this is national savings certificate and this is national savings annuity certificate. What is the difference? Here on maturity you start getting what? Annuity. And here you are not going to get any annuity. Here the entire amount will mature after 15 years and will be given in lump sum. You are not going to get any annuity. So there are certain plans, policies, or you may say there are certain investment areas, there are certain specified securities where you can go and invest. And on that, if you are getting any interest, that interest will be fully exempt. Now national savings certificates, if you see, national savings certificate, that is also a government certificate only. So you go and invest your money in NSE. What happens when you will go and invest in NSE? The investment made by you in NSE this year will allow you to take deduction under ATC. So whatever amount invested in NSE in this year will qualify for deduction under ATC. Now when you will start getting the interest from NSE, see, if I talk about NSE, NSE is a government scheme. When you invest here, that money gets freezed for next 15 years. You cannot withdraw that money from National Savings Certificate account, because the moment you put your money in NSC, that amount is with the government for the next 15 years now. Now the amount will come back to you after 15 years along with the interest which will accrue every year in NSC. It will accrue and again it will be reinvested in NSC. It will accrue and again it will be reinvested in NSC. Every year this will happen. Every year this will happen. The interest will accrue every year on NSC. Interest will accrue every year on NSC. Interest will accrue every year on NSC. Whatever interest will accrue, that does not become due right now. That is not received by you right now. That will become due, that will be received after 15 years when the NSC will mature. Getting my point? At that time this interest you are going to get along with the principal which you have actually invested. So right now invest. This money will come back to you after 15 years. Every year interest will also get accrued and it will accrued and get credited in your fund only. This amount of interest will not become due for 15 years. It will not be received for 15 years. Once at the time of maturity, after 15 years, the entire interest will become due and it will be received by you that time. So every year what will happen, when the interest will accrue and it will be reinvested for the second year. It will be again accruing and again it will be reinvested. For example, you are investing 1 lakh rupees right now. So that 1 lakh rupees amount which you are investing right now will be eligible for ATC deduction in this year. So first year now the interest will be there on 1 lakh rupees. And this interest on this 1 lakh, whatever interest is there for this year you're not going to get it back right now. What will happen? In the second year, again the 1 lakh will be your principal amount, but your principal will now increase. Whatever interest which got accrued for the first year will become the principal for the second year, meaning it will be reinvested in NSC. Getting my point, sir? So if the amount is getting reinvested, interest amount is getting reinvested, so the assessee will ask for ATC deduction, because whenever I invest money in NSC, for that amount I get the deduction under ATC. So the interest which you are giving me, showing me that it is credited, meaning credited in my National Savings Certificate and will be treated as a principal for the next year. So in the next year, my main principal will be there and the interest for the first year will also become my investment. So now on the second year, on these two amounts, I'll get interest. Now what will happen? Main principal amount plus first year's interest and plus second year's interest will be reinvested for third year. It will happen every year till 15 years. So for the first 14 years, what did I say? For the first 14 years, this will be treated as your taxable income and you are going to get ATC deduction also, but only for accrued interest on NSC. Only for accrued interest on NSC you can do that. Everyone, for the first 14 years, accrued interest on NSC, taxable under IFRS. Now this amount getting reinvested for the next year in NSC. So this year this amount will again go to NSC. Tax it under IFRS, going to NSC, take ATC deduction. Next year whatever interest will accrue, tax it under the head IFRS, now getting reinvested for the next subsequent year, yes or no? ATC deduction. This you are going to do for the first 14 years. Amount of accrued interest taxable as IFRS, since it is getting reinvested for the next year in NSC, so that amount will be allowed as ATC deduction. They could have directly given you this exemption. The amount which you are charging as what? Income, that same amount getting reinvested, same amount getting allowed as deduction under ATC, then why are you charging only? Don't charge, no. But they said no. Whenever this interest will be reinvested, no, that time you will come asking for deduction, because the amount of your income getting reinvested in NSE, so you will come asking for what? Deduction for that. So deduction for that will be available only if you show this amount as your income. No, that is the reason why it is first made as your income, then you are going to get the deduction. Sure. 15th year, what will happen? Last year when the NSE is supposed to be matured, only the interest will accrue, and that will not be reinvested for the 16th year, because on the expiry of 15th year, that entire interest is going to come for all the 15 years. So 15th year interest, only one effect. What? Accrued interest for the 15th year will be taxable as your IFRS income, but for that you are not going to get any deduction under ATC. And don't you think that interest for the 15th year will be the highest amount of interest? Government wants to charge tax on that amount. Hence, it is not giving exemption from the beginning. Very smart. If first year, what interest will come? 1 lakh. It's small amount of interest. That 1 lakh plus interest, on that a little bit more interest will come in the second year. Exempt. Still it is very less. First year main principal plus first year interest plus second year interest on this principal. In the third year the interest will be a little bit higher. Just imagine, principal amount plus first year interest plus second year interest plus third year, 14 years interest, and that too also increasing amount of interest. That entire amount is your principal, and on that 15th year interest will be calculated. That will not be a small amount, that will be a huge amount, very big amount. Once will be taxable in the 15th year and will not be allowed as a deduction under ATC also, because that is not getting reinvested under NSE for the next year, because 16th year NSE will not go, only on the expiry of 15th year it will mature. Will you remember? Sure, sir. A, B, done. Now come to C. If any relief bonds are issued by the government, relief bonds, government or RBI, on that relief bonds, whatever interest will come, fully exempt. If there are special bearer bonds, see, this special bearer bonds we saw in capital gain also, not a capital asset, and on that, whatever interest is coming, that is also fully exempt. Now the government sometimes issues 7% capital index bonds, capital investment bonds. So these capital investment bonds, on that also whatever interest will come will be fully exempt. Now bonds which are issued by local authority or state full finance entity, on these bonds also whatever interest you will get, that will be fully exempt. Now come to this H part. This is important. Now in the post office cumulative time deposit account if you invest, in the post office cash certificates if you invest, in the post office savings deposit account if you invest, whatever amount you invest here, on that amount you are going to get interest. That interest will be exempt under 10 subsection 15. But remember, only these schemes of post office, only these schemes of post office. I have nowhere written etc. Meaning all the schemes of post office, you invest, get the interest, we will exempt. No. Interest only on these post office investments. Post office cumulative time deposit account. What is cumulative? Time deposit means what? Time deposit. In the bank, when you keep a time deposit, it is known as FD, fixed term deposit. Fixed time deposit. Sometimes you call it time deposit also, sometimes you call it term deposit also, sometimes you call it fixed term deposit also, sometimes you call it fixed time deposit also, sometimes we call it sweetly fixed deposit, FD. Getting my point, sir? So if you invest in FD of any bank, on that if you are getting interest, that interest is, my dear friends, taxable for you. Okay, go and invest in the FD, cumulative time deposit account of any post office. Cumulative time deposit account meaning amount deposited right now, first year interest will come till the time you are not telling that you want that money back. Till that time it will be automatically reinvested, yes or no? So there is certain time, till that time you have to keep it with the post office. You cannot withdraw that amount. And after that, whenever there will be a maturity of your fixed deposit with the post office, whenever there will be maturity, at that time they will ask you, do you want this FD to continue along with your interest? Then will continue for next 5 years. You said, okay, no, I don't want money right now. Invest it. So the main amount invested in fixed deposit, first year interest, second year interest, third year interest, likewise, many years, every year what will happen? Interest will accrue, interest will be deposited. Interest will accrue, interest will be deposited. It is neither becoming due nor it is getting received right now. Why to charge tax on that right now? Getting my point? Sure. And even if you are getting that interest in your hands, it will be fully exempt under 1015. Cumulative time deposit interest. Then next is post office cash certificates. If you go and buy the post office cash certificates, whatever interest on that cash certificates you are going to get, fully exempt. Done, sir? Everyone? Perfect. Now, if you go and open a savings deposit account in a post office, sir, if you open a savings deposit account in a bank, then any interest on that savings deposit account will be fully taxable under the IFRS. But if the same savings account is open with a post office, if the same savings account is open with a post office, then you have a post office savings deposit account, yes or no? And whatever amount which you will invest in that savings account, post office savings account, on that amount you are going to get what? Interest every year. If the amount of interest on your post office savings account during the previous year, if the aggregate amount of interest from all the post office savings account during the previous year, if that amount is 3,500 or less, fully exempt. Threshold limit is there. This you are seeing for the first time for any interest. All the interest which you have done earlier and all the interest which you are going to do after this, there is no monetary limit. Whatever interest is there, no, that is fully exempt. But here there is a monetary limit. In the post office savings account, whatever interest for this year was there, no? Hello, sir. Will not be taxable, but to the extent of 3,500 only. If the interest is 3,500 or less, fully exempt. If it is more than 3,500, then up to 3,500 exempt and balance will be taxable as your IFRS income. This happens when you have post office savings account on your individual name only. But what if you have a joint savings account in a post office? Can you have a joint savings account in a post office? Yes. Me and my father, we both are having one joint savings account in a post office. My father being the secondary holder of that account, I being the primary holder of that account. If there are multiple account holders of a single account, no, one is the primary account holder, main account holder, first account holder, yes or no? First photo, first signature, meaning this account belongs to this primary. Primary means main account holder. All the other holders are secondary holders of this account. So whenever there will be some interest on savings deposit account which was jointly held by you and any of your family members or relatives, yes or no, on that you are going to get, on that whatever interest you are going to get, that interest will be exempt up to maximum 7,000 and not 3,500. Will you remember this? But small question. You should get this question. Ask. I'll give you time to think. Think what question should arise. Sir, this 7,000 exemption is given 3,500 to first and 3,500 to second. No, don't do it. Entire interest on that account is taxed in the hands of the primary holder. It is primary holder's income. So who is going to show that amount as income? Primary holder, no. So that only that person is going to take the 7,000 rupees of exemption. Getting my point? It is not given to everyone. Why? Because the interest is not getting taxed in the hands of everyone. It is taxed only in the hands of, it is considered as income only for the primary holder, main holder. Yes or no? So if I am the main holder of that account and not my father, so that is entirely my income. So I am going to get 7,000 rupees exemption. Understanding, no? Everyone. Okay. Now coming to the next one. See, if you are buying notified bonds of these public sector company, do you know public sector is different and public limited is different? All the public limited companies are not public sector companies, but all the public sector companies must be a public limited company first. Some public limited companies can be a private sector company also. Reliance is a public limited company, but it is in a private sector. Government does not have any control over that company. But if you talk about SBI, SBI is a public sector, public limited company in public sector. Because the majority shareholding in that company is of the government. So I am talking about those public limited companies where the government has majority shareholding, these public sector companies. So any of these companies are notified companies. By way of one notification, these companies are notified. These are the public sector companies which are notified. And for these companies, there are certain bonds, there are certain debentures which these companies will issue. So the bonds or debentures which will be issued by these public sector companies will be notified. Go and buy those bonds and debentures. Whatever interest you will get on those bonds and debentures, no, will be fully exempt. So notified bonds or debentures of which companies? These companies. Yes or no? Hello, sir. Now, tax-free bonds issued by India Infrastructure Company Limited, tax-free secured redeemable non-convertible bonds of these companies. Go and buy the bonds and debentures specified, these specified bonds and debentures for these notified companies. Whatever interest will come, no, fully exempt. Understood? You are supposed to remember all these names, not just this, the entire list which I am explaining right now. You are supposed to remember each and everything out of that. Will you? Sure. Let's see. Now, read this J part. Only this much you will read. Only this much. You are an employee who is getting retired from the CG, SG or public sector company. So you are the central government employee getting retired. You are a state government employee getting retired. You are a public sector company getting retired. Now on your retirement, are you going to get huge amount of retirement benefits, gratuity, pension, leave salary, etc.? Will it be a small amount or big amount? Very big amount. You are going to get lakhs, sometimes crores also. Just imagine 30, 40 years you have worked with the government, and within that 30, 40 years how much leaves you would have accumulated, leave salary. The government is going to pay you gratuity, huge amount. Now, if you don't have any requirement of this huge amount, instead of taking away that amount from us, keep that amount of your retirement money deposited with the government in notified deposit schemes. Money will be safe. You will get interest also, fully exempt. But if you will take that money, what are you going to do with that money? You are going to invest it somewhere, no? So rather than taking that money and investing anywhere else, earning returns, paying tax on that, and putting your money also at risk, it is better, no? Let your money stay with the government in notified deposit schemes of the government. You are going to get handsome amount of interest, and that you will be exempted. Getting my point? So by doing this, no, the government is saving its outflow. So to save the outflow, this much huge cash if you will take away, so there will be a huge outflow to the government, no? So government is saving, to save the outflow. The government is, offering you this benefit. So before taking money, you will think, what I will do with this much money? House I have, children have already studied, I have spent money, and I am not good at investing anywhere. Compared to FD, the rate is offered good. Putting my money in the stock market at risk, it is better to keep my money over here. So I will not take the entire amount. I will have a very small amount out of that for my, expenses and all. But rest the entire amount I will keep deposited in the notified schemes of the government, so that I keep on getting regular income in the form of interest, and that interest is exempted for me. See, this much benefit the government employees get. This is the end of 10.15. So in 10 subsection 15, no, all these securities and investments are notified. If you invest your money in any of these securities or investments, whatever interest you are going to get, that will be fully exempt under section 10.15, except for one interest on post office savings deposit. Hello, it will not be fully exempt. It will be exempt up to maximum 3,500, or if the account is jointly held, then it will be exempt up to a maximum limit of 7,000. Not a full amount, okay? No, full amount will be exempt only if the amount of interest is within the limit. And if the amount of interest is more than the limit, then up to the limit you can claim the exemption, and the excess amount you will have to show taxable under the head IFOS. Will you remember this? Now wait, there are two more interests which I would like to discuss here, which is exempt only, but not under 10.15. One is exempt under 10.11 and another one is exempt under 10.11a. See, when you invest in what? National Savings Certificate. So whatever investment you have made in NSC, no, for that you are getting ATC deduction. Now on that investment, whatever returns you will get, returns in the form of interest. Interest will also be fully exempt under, no, interest will be taxable. Accrued interest, taxable. And then you are going to get ATC deduction. And whenever the maturity will happen, NSC maturity. So at the time of that maturity amount, that will include the main principal amount you have invested, that amount plus the interest for these many years. That maturity amount will also be fully exempt, not taxable. Now pay attention. Now you invest in Public Provident Fund, PPF. Just like employees have PF, no, government has made Public Provident Fund account for the benefit of the general public at large. So if you also want to take the advantage of a provident fund, just like the way the employees are taking, come and invest the amount in public provident fund. So whatever amount which you are going to invest in this year in the PPF account, for yourself, for your spouse, for your children, yes or no? So whatever amount you have invested in your PPF account, amount invested in PPF account, amount deposited in PPF account, for that amount you are going to get ATC deduction. So every year, see, this PPF account is also for 15 years. For 15 years, you cannot withdraw the money out of this until and unless it is extreme situations. Okay, no? And that too also after some lock-in period, they allow you to withdraw that money. But the moment you have opened a PPF account, no, and the amount which you have deposited in the PPF account, no, now forget about that amount for the next 15 years. After 15 years, that amount will come back to you. Every year you have to invest some amount. Every year you have to invest some amount in PPF. Every year. And on that, on a periodic basis, the interest you are going to get. But that is not going to come in your hands. That is getting accrued. And again, it is deposited. That interest is credited in your PPF account only. So here also the compounding takes place. Every year, whatever amount you will deposit in PPF account, for that, you are going to get ATC deduction. This year I have deposited, I will get the deduction this year. Next year again I will deposit, next year again I will get the deduction under it. Every year, whatever amount I will invest, whatever amount I will deposit, for that I am going to take the deduction under ATC. Now every year interest will accrue. That interest is also fully exempt under section 10(11), fully exempt. And when the maturity will happen, at the time of maturity, whatever amount you have deposited so far in these many years, along with the interest accrued for these many years, that entire maturity amount will come, and that will be fully exempt under section 10(11) only. Yes or no, sir? Yes, sir? Now pay attention. Important thing. Now if you invest in Sukanya Samriddhi account made under the Sukanya Samriddhi scheme. Sukanya, you mean, you know what is Sukanya? No? You know Sanskrit? Sanskrit is a language. Just like Gujarati, Tamil, Sanskrit is also a language. In Sanskrit, no, a small girl child is known as Sukanya. And a small boy child is known as Sukumar. So Sukumar is a small boy child, but a Sukanya is a small girl child. So for the benefit of a girl child, this scheme is, prepared by the central government. Under this scheme, go to any post office. For PPF also, you are supposed to go to any post office or any nationalized bank. Just like that, for the betterment of your girl child, for safeguarding the future of your girl child, go and open a Sukanya Samriddhi account in any post office or any big nationalized bank. Go and open a Sukanya Samriddhi account. Yes. In that scheme, in that account, every year deposit some money on the name of your Sukanya, on the name of your girl child. Every year, whatever amount you will invest in the Sukanya Samriddhi account, no, will be allowed as a deduction under ATC. And on a periodic basis, the interest will also be credited. So the interest amount credited will be fully exempt under section 10(11)(a). And when your Sukanya will become Kanya, Sukanya will become Kanya. She'll grow. She'll be matured. That time, for her marriage, the money will be required. For her higher education, the money will be required. From where the money will come? This account by that time will mature. And on maturity, you will get the money. And that money will now be used for the benefit of your Sukanya, who has now become Kanya. Getting my point or not? For her better education, higher education, that amount can be used. For her marriage, this amount can be used. So that time, whatever maturity amount will come, that will also exempt under section 1011A. Will you remember? Okay. We were talking about interest. Just see where I am making the connections. Some amount will also come at the time of maturity, that is also exempt. Right now you invest the amount, that also you take as a deduction under ATC. But the interest which will come, no, will be exempt under these sections and not 1015. As per these sections, claim the exemption, don't show these interest taxable anywhere. Getting my point, sir? Now I have one small doubt. Should I ask you? This is previous year. And this is assessment year. In the assessment year, total income of previous year 24-25, will you calculate? You are not going to calculate this total income in the previous year, no? Previous year's total income you are going to determine in assessment year. And on that total income, you will determine the tax liability also. You will apply the tax rate and you will calculate the tax liability. Now, don't you think that this tax liability, government makes every effort to take this tax liability from you during the previous year only in the form of TDS, TCS, advance tax. Almost the entire tax liability government takes during the previous year itself in the form of TDS, TCS, advance tax, etc. Now in the assessment year, whatever calculation you are making, it is just to know that how much was the exact tax liability and how much you have actually paid. So the exact tax liability is this much. You came to know that your exact tax liability was 2 lakhs only. But during the previous year, while earning the income, you paid the TDS, TCS gone, and advance tax also gone. Possible or not? All these taken together became 2.5 lakhs. Meaning that in the assessment year, you came to know that you are actually liable to pay how much tax? Only 2 lakhs. But during the previous year, how much actually tax you have paid? 2,50,000. 50,000 more tax you have paid. Are you going to pay any tax to the government in the assessment year? No. You will tell the government, don't even dare to ask for the tax because bloody my tax is only 2 lakhs. I have deposited that entire 2 lakh and in over and above that 50,000 extra I have given you. Give me back my 50,000. Will you claim the refund of the extra tax paid by you in the assessment year? That 50,000 refund whenever it will come, no. With that 50,000 refund, interest will also come. 0.5% interest. Sir, 50,000 refund coming. Not your income. Ignore. Because the tax which you have paid extra, that is coming back to you. How can that be your income? Ignore that. Ignoraya nama. Extra amount coming with that refund in the form of interest on income tax refund. Is that interest your income? The answer is yes. Only that interest component is your income. So with 50,000, you are going to get 5,000 extra, no? Example, 5,000 extra. So how much you paid extra? 50. You are claiming the refund of 50, but the government is giving you 55. So in that 55, 50 was your income tax refund only, no? What about that 5,000? That is interest on income tax refund. Is it your income? Yes. Is it exempt? No. It is not exempt anywhere. Meaning it is taxable, sir. Yes, it is taxable. Sir, where should I tax? Try to tax it in the earlier 4 heads. You will not be able to do it. General charge 56(1) will be chargeable under the head IFOS only. So I have given you this notes, no? In these notes, in the main chart, no, interest on loan or deposit with bank, here only I will include and interest on income tax refund. Income tax refund, not your income. Therefore, ignore this amount. But the interest is equal to your income, and that will be taxable under the head income from other sources as per general charge under section 56(1). Is it visible, everyone? See, I have already given this in a note, but I wanted to show it in the chart. In the note, you are going to get this note number 4 or 5 if I am not wrong. Okay, no sir. Now pay attention. One more important thing. This is what? Salary minus TDS, net salary. This is what? Winnings minus TDS, net winnings. On salary, TDS is deducted. Yes. Where it is written? Section 192. On winnings, TDS is deducted. Where it is written? 3 sections. 194B, 194BB, and new section 194BA. Here there was a threshold, here there is no threshold. Yes or no? Now can I say there are provisions for what? TDS on interest also. So from your interest income also the TDS gets deducted, and net interest you get in your hands. This is given under section 193 interest on securities and 194A interest other than interest on securities. So whenever someone is going to give you interest, so as per section 193 or 194A, they have to deduct TDS. So would they deduct TDS? Yes, they have deducted your TDS. So after TDS you are getting how much interest? 90%. For example, 10% rates are there. 193 and 194A. The rate of TDS is 10%. So the payer will deduct TDS at how much rate? 10%. So interest is 100, TDS is 10%, net amount will be given. Will you charge net amount under the head IFRS or gross amount? Always the gross. Here also gross, here also gross, here also gross. Whenever there is a TDS on any amount, please, net amount you are getting, no, in that net amount, please add the amount of TDS, make it gross, and gross amount you show as your income. Always. Sure, no sir? That we have done in salary also, that we have done here also in IFOS, hello, with winnings. Now I'm talking the same thing about what? Interest. So how much amount you will show taxable? Gross interest. The TDS which got deducted, for that you are going to get credit out of your tax liability. And net interest is something which you take home. Take home is not taxable, gross is taxable. And in that gross, TDS is also included as your income. For that you are going to take what? You are going to take credit of that TDS from your tax liability. It will be reduced. Will you remember all these things? So note number 1 done, 2 done, 3 done, 4 done, 5 done, every note done. Done. Now, the next lecture we are going to start from here, rental income. Okay. So tomorrow the entire chapter will be over. Majority of the part we have completed. The big things we have already completed. I don't want to keep this thing in between, so I'm not going to discuss this thing right now. Okay. Tomorrow we are meeting, and tomorrow I'll start from rental income. From here we'll start and we'll finish this chapter tomorrow. Okay. Now not many things are not remaining. Very few things are remaining that we are able to do tomorrow itself. Okay. So tomorrow this chapter will end, and then from day after tomorrow we'll pick up the other chapters. Very small chapters are remaining now. Okay. So see you all tomorrow. I'll text you the time for tomorrow's lecture. Okay. See you all. Bye bye. 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 Take care.